Welcome to Frank Wealth Insights, a financial and investment podcast from Return on Life Wealth Partners. They look at your money. We look at your life at returnonlifewealth.com.
Hello, everyone. Thanks for tuning in to another episode of Frank Wealth Insights. I'm Frank Fantozzi, President and founder of Return on Life Wealth Partners. Before we get started, got to know from our legal team that for protection only, we have to read some disclosures here. The information discussed is general and educational in nature only and should not be considered legal or tax advice. Tax laws and regulations are complex and subject to change, which can materially impact your financial results. Return on Life Wealth Partners cannot guarantee that all the information discussed is accurate, complete, or timely, and as such makes no warranties with regard to such information or results obtained by its use. Therefore, we disclaim any liability arising out of your use of any or any of these tax positions taken in reliance on or if such information is used. So now that we have that all out of the way, we're excited to have as a special guest Kate Shackleton, Executive VP of Trust and Insurance from LPL Financial and Private Trust Company, headquartered right here in our backyard in Cleveland, Ohio. So how are you doing today, Kate?
Great. Glad to be here. Thanks for having me.
You're welcome. Yeah, we're excited. How's your summer been going so far, though?
Summer's been good. It's flying by, doing lots of travel, but it's been terrific. How about yours?
Well, what's one of your favorite spots that you traveled to so far?
Oh, let's see. Well, I just got back from New York and was out at the beach on Long Island, and that was pretty great. So
awesome.
Can't complain about that. Yeah.
Yeah, we just got back from Green Bay. It wasn't on my bucket list of places to go, but my daughter was in a wedding party, so we had to represent. We got invited. And it's interesting to see a town of just 100,000 people have a professional NFL team and the whole complex built around Green Bay. So they definitely have an advantage when a team is owned by the city than Cleveland when we lost our Browns team to the Ravens. And then the year after we lost them, they won the Super Bowl.
I don't want to talk about
Nah,
that. Those were tough times in Cleveland, but
definitely.
We bounced back.
That's right.
Yes.
This year, Deshaun Watson's going to bounce back after 2 years of not doing much, and hopefully we're gonna get farther into the playoffs than we did last year.
This is our year.
So we're here today to talk about some advanced planning issues, and it really revolves around the use of a trustee, and with a little bit of a focus more on why you might want to use a corporate trustee. But I think we want to start out for our listeners to understand what's the purpose of a trustee, why do we have trustees, what's their role in financial planning and things like that.
Well, I think if you think about why you want a trust to begin with, it's for a variety of reasons, but not the least of which is it gives you protection for your assets. It gives you privacy. It gives you the ability to really have your preferences known and documented and followed when you have passed or become incapacitated. So it really gives you, I think, peace of mind. How's that for 4 Ps?
For sure. Well, it sounds like it's like a will that's been given superpowers. You kind of have more things that you can do with a trust in general. And I think the whole thing about privacy is very, very important. And building in the wishes of the grantor, the person that creates the trust, into the language is really critical.
That's right. In fact, the privacy issue is an interesting one because if you have a will, it has to be filed when you go through probate. And just as an anecdote, I was doing some ancestry work on my family, and I was able to read wills from a couple hundred years ago because they had to be filed in probate. You can see what people's wishes were. And with a trust, you don't have that same loss of privacy. So there's a lot of benefit to it. Well,
it's interesting you bring that up. One of my classes I took in grad school was on estate planning. And the one case they always cited was John Wayne. He was a famous actor. I'm dating myself now because kids today don't even know who John Wayne is. But he died in Orange County, and he died without a will. And everything he had went through probate. And so that's a big issue. So I think privacy, especially for those that have net worth, or for those that just want privacy in general, a trust is something that you would want to consider, right?
Absolutely. There's also the timeliness factor. I mean, probate's a lengthy process, and the person that you're leaving the money to might need those funds right away. They might need it to carry on a family business or other obligations, paying the real estate taxes on property that they've just inherited. So going through probate can take time, and not everyone has the benefit of being able to afford that period in between. So there's a lot of benefits to having a trust. So
it creates basically a little more ease and continuity. It's less interruption.
Yes.
I mean, it's already difficult, obviously, when someone passes away and you have to deal with, their final wishes. But having a trust kind of takes away some of the speed bumps that you might have.
That's right. Absolutely. It is a difficult time. And I know we'll talk about this a little bit throughout the course of the podcast, but these are difficult times when someone has either lost a loved one, they've passed away, or maybe they've become incapacitated. You're already dealing with a lot of emotions, a lot of other challenges. It's nice to know that there's some structure in place and you've got some support around you.
So what you're saying then is a trust, if I'm the person that creates the trust, I have a better chance of kind of laying out my wishes and how I want things done so that the people that have to follow the trust, I'm making it easier for them. I'm letting my intentions be known.
Yes, you're laying out a roadmap. And when we're looking at a trust and we're evaluating the wishes as you described it, they have to be reasonable. They have to be things that are quantifiable. But it gives you a lot of leeway to really state your wishes and to have those fulfilled. So yeah, there's a lot of benefit to it.
Yeah. So you create this trust, but the trust doesn't just operate on its own. There's someone that is in charge of the trust, and that person's often called the trustee, correct?
Yes, or the executive. Yep.
And so, and it's not always a glamorous role either. Sometimes maybe you could talk about that first.
Sure.
Like, what is a trustee? What does it mean to be a trustee? What are some of the key duties for a trustee? And why isn't it for everyone?
So when you think about it, you are in a position now where you have to effectively stand in and act almost as a financial professional, right? You've got to be able to understand what's in the document, financial and legal to that extent, understand what's in the document, understand how to execute those wishes. You might have to be dealing with other financial professionals, accountants, estate attorneys, etc. So you're really, if this is not your day job and you've stepped in, maybe your brother named you or your uncle named you, now all of a sudden you're saying, okay, I've got to read this document. Can I do all these things? Do I know how to do all these things? It's challenging. There's also the added complexity of you're dealing with family dynamics.
Right. That could be even harder.
Yes. You can't talk about trust without family dynamics. So one of the things that I think really is challenging when you're asked to serve, and oftentimes we do name a family member, and that's fine if you've got a relatively straightforward estate and there's not a whole lot that needs to be dealt with, but that person is then going to have to potentially deal with selling your home, transitioning your investment accounts. They'll have to take stock of all the inventory. Maybe in the trust it says that my jewelry should go to my granddaughter and I want my art collection and my baseball cards to go to my nephew. Somebody's got to go find all that stuff. It might be in nooks and crannies in the house and hold on to it for safekeeping so we know it goes to the right person. There might be a lot of people that have access to the family home. You might have to go engage a locksmith right away to make sure it's locked up if people don't start going in and grabbing that favorite painting off the wall. It's challenging. You're fending off a lot of different forces. And then again, the technical matters of when you're dealing with anything with the legal system, you still may have to deal with probate court in certain instances. These are full-time activities that oftentimes result in you needing to be in person somewhere.
Correct.
Which is the other challenge too.
Well, then you have other issues too. Like trust is its own entity, right?
That's right.
So I would imagine then the trust has to file its own tax return.
That's right.
And there's complexities all involved around that aspect of it.
Absolutely. And yes, you're right. It needs its tax ID. You might have to repaper all of the accounts depending on whether they're going to be distributed and held by trust or they're immediately going to distribute in other ways. You've got to go collect life insurance premiums and deal with that. So there's a lot of things to closing down an estate, if the estate in fact is going to be closed, but also if it's going to be in perpetuity and it's built to provide charitable contributions according to the wishes of the grantor. There might be more than you think.
Right. Oh, and that's where I think where it could get even more complex. It's one thing, is it safe to say that if the trust is going to be terminated, it's just acting as we call it by operation of law. Assets are just going to pass by what the trust says and it goes to those people. That's going to be hard enough just dealing with the beneficiaries and closing down the estate. But then there's that added complexity that if the parents, say, set up money in a trust fund to take care of their children, either as minors or even as adults, because a lot of times we find that parents who've accumulated a lot of wealth, and their kids in their 20s, they're not willing to turn over all their wealth right away to their children, so they might piece it out piecemeal. So now you have these ongoing obligations. So now the trustee has to stick around for a while, right?
And use some judgment.
Why don't you talk about some of that judgment then?
So it's generally written that you're taking care of things like educational expenses, healthcare, etc. But beneficiaries might see that in a gray area.
Right.
And someone has to determine, does this meet the expectations of what the grantor was thinking when they wrote their trust, and use some judgment. And it can involve asking for a budget.
Right.
Who wants to ask their cousin, hey, give me your budget? How much are you spending every month on travel? What's your Christmas gift budget for you? Do you have any outside income we don't know about? It gets really invasive really quickly to the beneficiaries. And then there is this question of judgment. Is this an appropriate expense? Should you be asking the trust for that? If you ask for too much, will the trust survive you? Because that's the other piece of this, is if someone has expected the trust will survive the beneficiary's life, maybe even to the next generation, can't drain the trust. So there's a lot of no that comes as a trustee.
Yeah, one of the things we found is this common clause of for the client's health and maintenance. Mm-hmm. One person's health and maintenance needs, what they're used to, is different than another person's needs. Right. So then how is the trustee going to then vet that out and say, okay, what did the grantor, the person who created the trust, what was their intent, right? Mm-hmm. What is the standard of living and health and maintenance that I wanted to see for my children? I see this, but they might see that.
That's right.
And then you have a problem with someone arguing, like you said, for money.
Yeah. Well, and I think to think about a professional trustee versus having a family member do it, we're looking at these every single day. Mm-hmm. We're getting these requests, and normal and customary to us may be something because we've seen over the course of our careers in this industry, or the trust companies that are around for decades. We've seen these requests before. We know what would stand up in court. We know what would meet the expectations of again, this concept of really normal and customary. Whereas someone who's doing this for the first time and maybe only time in their lives, they might have a hard time with that.
Right.
They might not know what meets those expectations, and they might be putting a personal bent on it. So it can be challenging quickly.
So you bring up an interesting fact. So we're talking really about trustees in general. The three primary responsibilities. One is to administer the trust based on how it's written by the grantor, the person who passed away and created the trust. They have an obligation of loyalty to the beneficiaries, and they have to deal with each beneficiary impartially. In other words, one can't be favored. But now you bring up an interesting point. I'm an individual. I get named as a trustee, and I'm like, this is way over my head. I don't want to deal with all this. Mm-hmm. It's too much stress. I don't think I can do a good job. Mm-hmm. So now they have this ability, and often I've seen in documents where if someone doesn't want to serve as an individual trustee, the grantor sometimes will name a corporate trustee.
Yes.
So why don't we talk about how a corporate trustee, some of the advantages that a corporate trustee really brings to the table versus having someone as an individual, a family member, or even a spouse for that matter.
Yeah, we've touched on this, and I would say you're right. You could name your family member. They could either resign or decline the appointment, and it's really helpful to name a successor trustee. And we often suggest name a corporate trustee. You've got the factor of perpetuity, right? You may have written your estate planning documents many years before you pass away, haven't looked at them. Maybe the person you named predeceases you.
Right.
You've got a successor trustee written, you've got a backup plan, right? And naming a professional in this case, you're hiring a company. The company has a much higher likelihood of being around when they're called upon to serve. So
they also have a deeper bench, right?
They have a much deeper bench. That's right. Of expertise and this perpetual nature. We've touched on it. You're certainly going to get someone who's got a higher likelihood of being impartial. I mean, it's not to say we're all perfect, right? But they're really looking at it as a third party. Their role there is to follow the letter of the law, the intent. They've got a deep understanding of what the obligations of a fiduciary. And some of the other things we've touched on in a professional trustee setting. You've already got someone who's going to take care of all of the obligations of the trust, the payments. Let's say you own real estate in the trust. Somebody's got to make sure that the insurance is paid and the like. So you've got someone thinking about that. You've got someone who's thinking about the filing of the tax return on behalf of the trust, which is important. And just sort of the periodic and episodic things that are going to come up. The other thing that's important, depending on how the trust is structured and the relationship you have with your investment advisor, they're also going to help select an investment advisor for the trust. Because effectively, once you name a corporate trustee, they become the client. And it is the corporate trustee's job to select an investment advisor. And depending on the structure of the corporate trustee, that can allow you to ensure that the investment advisor you worked with in your lifetime is the same investment advisor that's going to manage your money once you're incapacitated or you've passed away.
So that sounds like it's one of the questions we'll get to later, but one of the questions you'd want to ask is, when I set up my corporate trustee, and our family's been working with this financial advisor in their firm for a number of years, and we want them to continue, part of the risk could be, depending on who we select as a corporate trustee, they might decide to say, hey, well, that's great, but once we become the corporate trustee, our whole team's going to take over and you can't use your investment advisor. Is that fair to say?
Yep, that is absolutely fair to say. So corporate trustees come in different flavors, and trust departments have different services they offer. I happen to be part of a trust company that is very focused on administering trusts, but not focused on investment management. So we are generally serving in a capacity which is called a directed trust, where we are selecting an investment advisor to do the investment management. And we are going to direct them, making sure that they meet the obligations of the investment policy statement, that they meet our expectations from an investment management oversight standpoint. But yes, there are different types of trust companies. Other trust companies might say, just as you explained, now that you have selected us, we're going to provide a full service suite of solutions. You're going to pay one fee, and it's going to include everything from trust administration to investment management. Right. You might end up with a different experience in that instance.
Well, the beneficiaries will have a different experience because I'm not going to be around.
That's true, but it might not be making quite the expectation that the grantor had.
That's
which
right.
Is that you're my guy. I trust you. No pun intended.
Yeah.
And I want to see you help my family even after I'm long gone.
Okay. Mm-hmm. So part of the pros of having a corporate trustee is their expertise. As you said, their continuity, they're going to be on in perpetuity. Impartiality, they have the expertise from a regulatory and oversight standpoint, and hopefully they have the administrative efficiencies because they've been doing this. This is not their first rodeo, as they say.
That's right.
So what are some of the cons? Because there's no free lunch. There's always a give and take as some of the potential negatives of working with a corporate trustee versus an individual trustee that might know my family and things like that.
So it comes at a cost. Certainly, you hire a professional trustee, and it's going to cost. Generally, it's a basis points on assets fee, similar to an investment fee.
So that's like a percentage based off the amount of money the assets have.
Similar to an investment management fee, we might charge 1% on assets.
Yeah. Okay. Thank you.
And then there's there may be some additional fees. We might have an extra charge for filing the tax return, or an extra charge for managing the real estate if it's a complex real estate portfolio. So there could be some additional charges. So certainly that's a con in some people's minds. Although again, like to the point, some of that gets pretty complicated pretty quickly. So you may think it sounds expensive until you have to do it yourself and you realize, wow, this costs me a lot of my own personal time.
Yeah, and there's money to that for sure.
Absolutely. I would say that another con is it might feel impersonal. The beneficiaries might feel like these people don't really know my family. They didn't really know my grandfather and what he really wanted to give me and his intent. And certainly, like any company, we have turnover. So you might have a trust officer that you really enjoy working with, and they might retire. And now you've got a new trust officer 10 years into being a beneficiary. Whereas, Uncle Bob's around the whole time. So, there's certainly considerations to be had, but it's not just because I'm in this business, but I do think the cons are not outweighed by the benefits of choosing a corporate trustee.
Right. Well, and I think in some respects, you take the family member, which, again, I always tell people, when you're named as an executor and a trustee, it's a big ask. And it is a lot of work. It's a lot of stress, especially when things don't go well. When you have a family where there's dynamics where the black sheep of the family is arguing about why they're not owed this or I deserve this. Well, wait a minute, that's not how it's written in the document. Mm-hmm. And then they have representation that wants to challenge the trust. Mm-hmm. So, there's all kinds of horror stories. I actually been in Cleveland a long time, and there was a family called the Horowitz family. And the father, the patriarch, set up a trust to manage the three primary businesses. It was in media, newspapers, construction, and real estate. And when things were going so bad in regards to all the beneficiaries challenging the trust, there was actually proceedings that you could read about where there were arguments and fighting in the courtroom. It got so contentious that the government just got fed up and they dissolved the trust, which is very, very rare. They dissolved the trust and forced all the assets to be sold and everything to be liquidated and given to all the beneficiaries because they couldn't agree. I mean, that's a worse outcome, and it's very, very rare. But it was one of my experiences I had early on in the accounting world when I worked at Arthur Andersen. So
I think you nailed it, though. Like, this comes down to emotion, right? It comes down to what the family members expect from their family situation, whether it's ownership of assets or a certain stipend to maintain a lifestyle. It gets very complicated, especially when you've got a large family, you've got many different wings to the family. People are living all over the country. Maybe some have some special needs.
Correct.
Whether it's any form of disability or maybe addiction, things get complicated really quickly. We've had some instances actually where we have had trusts where the grantor is alive and they've put money into trust for their special needs child.
Okay.
And it really was in part to create separation from their child and their child's addiction and being able to help the child. And where we're asked to step in and ensure that drug testing is occurring on a regular basis, that they are living a clean lifestyle to maintain their requirements from the trust in terms of being able to receive any kind of monthly stipend. It allowed the parent to be a parent and for us to step in as a sort of an intermediary into that relationship, and they're grateful for that. Most families have some sort of issue.
Right.
And it's a great example of how you can use a trust even in life to help sort of stabilize your family situation.
Sure. Well, what are your thoughts on this? Because I've seen this used. Now, I would like to get your opinion. I think one of the challenges families have when the matriarch or patriarch pass away and there's a substantial estate, or any estate of any size for that matter, because it's all relative, right? What someone considers a lot of money at $1 million, someone doesn't consider a lot, until they get to 50 million or 100 million. What are your thoughts of family meetings where the patriarch and the matriarch really share their plan and share their wishes so that when they do pass, the trust and all of its rules aren't a surprise?
Family by family, it depends. I would say that there are many families that are concerned that sharing what the children are going to receive or the grandchildren are going to receive may hurt their desire to work hard and build a life for themselves and really create their own income and their own success. Other families, I think, follow along the lines of what you're describing, which is we want the children to know what is in their future and what they can expect. And maybe it impacts how much they need to save for their own children's education because it's going to come down. I think your family situation is unique. Personally, I'm a believer in as much transparency as you can give, because I think you're right. You're going to set someone's expectations ahead of time. You have to know your children and your family members and know if they can handle that kind of information.
Right.
And not everyone likes to think about the inevitable either.
Yeah, those are tough conversations. I had a client that actually redacted the numbers, but basically said, okay, this is how things are going to work. We're going to have an account set up for XYZ, and it's going to provide money in this way. This is what's going to happen to this asset and this asset. This is what's going to happen to the summer home. And so, they were careful to your degree, based on the maturity level of the beneficiaries and what's really happening. I think there's timing in how you start to release information. But at a certain point, if your children, say pick an age, 35, 40, if they haven't figured out life by that point, are they really going to get any better? So, you telling them what's going to happen and how it's going to happen, as you pointed out, full transparency, whether they like it or not, I think puts the trustee, whether it's a corporate trustee or an individual trustee, in a better position to be successful, because they are usually not the parent. If both parents pass away, then it's maybe a family member, maybe it was their CPA, maybe there's a financial advisor. But you don't want to set the trustee up for not being successful, because if they're not successful, your intentions become less successful.
That's right. Someone might contest the trust at that point. I think it's also important if maybe you have a high degree of charitable interests and you plan to give away a significant portion of your estate to charity, and your family members are depending on that. It's better to tell them sooner than later that what they think that they've been depending upon may not come their way.
Right.
And that's a really important thing to share as well.
Yeah, because I think some family members start to figure out that, my parents are probably worth a certain amount of money based on the cars they drive, the house they live in. It's like, okay, they're not getting by on very little. You're right. They might have false expectations, and some parents feel like, hey, we've done enough. We've given during your lifetime. We're going to give you something, but we're not going to put you in a position where you could just sit back and kick up your heels at age 35.
That's right.
And I think there's something to be said for that. And I think that goes to the intent of the grantor, the person creating the trust. It's their wishes, it's their assets. They have every right to decide how they want to see their monies used, who they want to see benefited, how they want to see them benefited, and what the stipulations are to get those benefits even.
That's right. And think about the tax implications too. What if the assets are of a certain level that it really makes sense to do a generation skipping trust?
Right.
Then you've got to have that conversation as well. And so I think that, we're not going to get into the technicalities of different types of trusts today, but in certain cases, the estate planning may make more sense to pass the assets on to a different generation, and that could be really eye-opening.
Yeah. So it's safe to say, in general, almost any type of trust will have someone serving as a trustee.
Yes.
Right, because like I said, we don't have enough time to get into the multitude of trusts that are out there. But the option for someone who wants to create a trust has the ability to select an individual or really consider, is really a corporate trustee something better? Now, have you ever seen a co-trustee where there is a corporate trustee and an individual?
Yes, absolutely. We serve in that capacity today where maybe you want to have someone do all the administrative work, like we've talked about, filing of tax returns and things, but you still want the family member to make the core and critical decisions around the investments, let's say. That's very much an offering that a lot of trust companies, professional trust companies will have, and we're serving as the co-trustee. And
you're saying that because they probably have a better idea of, Sally's needs versus Fred's needs, and what's health and maintenance. They're in a better position to understand maybe what the grantor wanted versus the corporate trustee. Or
they may say, we want you to handle that part, but we want to do the investment decisions because this was a family business. All of the wealth was generated by our family, and we still want to really have a heavy hand in that part of the corporate trustee's responsibilities.
Okay. So some of the key roles we talked about, it's the administration, it can be the investment management, there's the fiduciary duties and acting in the best interest of the beneficiaries, the tax planning and compliance, which no one likes.
Unless you're a tax guy.
Yeah, unless you're a tax guy. That's my job. And then legal responsibilities. So now, if I'm figuring out who I want as a corporate trustee, what are some of the questions I might want to ask? And it's not going to be an exhaustive list today, but some of the key questions I might want to ask, maybe start out with the easy one, like, okay, how much does this cost?
Right.
What other ideas come to your head? And if I'm interviewing different, bank or private trust company, or some of the big investment houses that have trust departments, what are some of the questions you think, someone should be asking?
Well, I think it's important to start with, as you highlighted, what is this going to cost? What are your fees? Because part of that will expose what are the services that they're really providing to your beneficiaries. So I think it's really good to get a good handle on that. And it touches on a bit of what we discussed earlier. If let's say you name a large financial institution as your corporate trustee, they may, as part of that acceptance of performing that role, they may say, yes, but you need to consolidate all of the assets with us. And this is actually a really important point that we should touch on. Just because you name a particular corporate trustee doesn't mean that they're going to serve.
Right.
So at the time that you name them, you don't even necessarily have to tell them that. They may not know you named them.
Yeah.
Your lawyer might have given you a recommendation. You put that in your document, and we never know. This happens to us all the time.
Okay.
Lawyers contact us and say, you've been named in this trust document. We say, great, can you send us the information? And we need to see the trust document, and we need to see the investment statements, because naming a corporate trustee, it is then incumbent on us as a corporate trustee to review what's in the document and make sure that we can serve. Either
you can comply with it.
We can comply, and it also complies with the way we run our business. Do we handle these types of assets? Is this document written in a way that we're comfortable that we can serve legally, and the document itself will stand up in court? So we have to accept the business. So once you've named us, we still have to accept it. And so that's another thing. It's it's important to talk to your corporate trustee, to your point, to ask the questions around your intent to make sure that it meets the way they run their business. If you say, hey, I want my advisor to be the advisor on my assets after I pass, are you okay with that? they may say, well, that's actually not the way we run our business. We become the advisor of the assets. And so you want to know things like that. You want to make sure that you're comfortable with their location and their jurisdiction, that it's not going to have undue tax consequences to your beneficiaries because the trust is all of a sudden being administered in a state that will tax the trust.
Okay.
So there's aspects to the technicalities of naming a corporate trustee that do matter. And I would say too, this is one where you want to get a couple of opinions as you're doing this. You do want to, ask around, ask your trusted experts in your network, whether it's your financial advisor, your attorney that's drafting your documents, who have they seen, really do a fantastic job by their beneficiaries. And, of course, you won't necessarily know who's going to be helping your family members at the time upon which they're called to serve, but you want to work with a company that's been around.
Right.
So I think it's important to understand how long have they been around, how much are they managing. Trust companies measure by AUM, so we look at assets under management.
Right.
The trust company that I am involved with manages $2 billion in assets. That's a healthy amount of assets. We've been around for a while. We have 1,600 families we're serving. We incorporated, regulated by the National Bank regulator for almost 30 years next year. Shows that the perpetuity and
strong credentials.
Strong credentials, that's right.
At the end of the podcast, I will give some information out. If people want a list of common questions to ask, we'll provide that to anyone who wants these. They can just either email us or call us for that. Are there any other key takeaways that you think we should talk about today? Something we didn't cover?
Sure. I would say now's the time. It's always the right time to be thinking about these things. You can always amend your trust. As long as it's a revocable trust, you can amend your trust. Even if it's an irrevocable trust, you can always go to court to make amendments. But even setting up a revocable trust today that becomes irrevocable upon your passing, it gives you peace of mind.
Right.
You know that you're should something happen, that your family is going to be taken care of. It's one of the important things that you should be thinking about. I'm sure you talk to your clients about this. Get your healthcare power of attorney,
right.
Get your estate planning documents in place, and really be thoughtful about who it is that you want to be responsible for fulfilling your wishes.
Oh, great advice. I know I'm a shoemaker, so I'm always the last to do my own work, and my wife and I are going through the same thing. We're going through our estate planning documents, and we did it when both our kids were minors. Now both of our kids are adults, and some of the people in our lives have changed. Mm-hmm. So now we're sitting there going, okay, all these people we put in place of important roles within our lives in case my wife and I passed away, those roles have changed. So one of the things we talk about with our clients is, anytime you have a life event, for sure, you should be reviewing your estate planning documents, your beneficiary designations, your powers of attorney. And even if you haven't had a life event, probably every 5 to 7 years, take some time to go through it, make sure, are your wishes, like you said, are they still consistent with you? Sometimes as life happens, people move in and out of your life, how you feel about family members and friends and charities change. And so you want to keep your documents as fresh as possible so they can represent, the best interests of what you, and if you're married, your spouse want to have happen upon your passing.
Absolutely. It's a small investment to make, and both of your time and of course of legal fees to get the documents drafted, but it's so worth it in the end. And we talked a little bit about how do you bring family into the discussion. I think the holidays or your summer vacation trip where you're gathered together, spend a little time, make it part of the routine so it doesn't feel awkward. If you do it every time you get together, hey everyone, it's important for us to just, talk about this as a family. What are our wishes? I think that, that concept of a family meeting can be really important. And to the point too, let's say that part of what you're trying to do is to leave some money to charity. Let your beneficiaries be a part of that conversation. Right. Let them see, 10% of the estate went to charity, but gosh, mom and dad heard me, and they know that animals are important to me, and they're giving to an animal organization as part of this. So even though I didn't give it directly, they know that this is important to me, and we all agree that was a good use of the money. I think it's just normalizing these conversations really goes a long way.
Yeah. Well, and I could see the challenge. I know it becomes very sensitive when you try to be transparent. I think that's the right thing to do. We've had families that will hire, whether it's their CPA or their financial advisor attorney, to act as a facilitator, so that mom and dad aren't having to lead the discussion. They can participate as a member of the family, and then really it's the facilitator that's going through and explaining, okay, this is how everything is working, and then opening up the floor for questions. Because it's very difficult when you have to facilitate while you're also a member of the family. So we've found that, especially when things get a little more complex, that having a facilitator who can take the pressure off of mom and dad, so mom and dad are not under fire all the time, because that's how it feels. Like, you've, as parents, you've worked hard to create this net worth, and you're trying to do right in your mind by your family and charities, but not everyone is always going to perceive it that way. So if you can have someone there to help facilitate, it does take some of the burden off.
And is that something you do for your clients?
Yes, we've facilitated quote family retreats where, like you said, they have a vacation, and then we'll come down on the front end for a day and have the family meeting, go through everyone's relaxed, they're out of their house, they're hopefully a little more de-stressed in a good place, and we prepare the forums. We obviously talk to the parents prior and say, all right, what do you want to accomplish? What's safe to talk about? What are things that you don't want to talk about? Because again, every family is a little different about opening up the blinds and saying, okay, I want to show you everything. And so part of it is doing it piecemeal, so that you kind of ramp the family up. But yeah, conducting family meetings, it can be tricky because most of the time it works well. There's always a little level of emotion because people, like you said, have a different view on their mom and dad's estate than mom and dad have their own estate. And once in a while you have one situation where it could be rough, and then you need to figure out how to handle it. But it's easier if a third party that's not a member of the family can take the brunt. So if someone is disgruntled, they're really going to aim that at the facilitator a little more than mom and dad, and it takes a lot more pressure off. So I think having it facilitated, especially if the parents feel it's going to be hard, is a better way to go. If they feel totally capable of handling it and dealing with whatever dynamic is going on, then you don't need a facilitator. I think it's just an option that people should consider.
Absolutely. That's a wonderful service for your clients. I think the fact that your firm is willing to take the time to go meet with the family and to presumably also provide some educational resources for the next generation that might not be as savvy as the parents are with respect to wealth management.
Thank you. Yeah, well, part of it is too, I think parents, if they have a great experience with our firm, it becomes what we call generational wealth planning. When we start meeting with clients, it's not only focusing on mom and dad and their estate, but they realize that they're not going to use all their money, and they want to see their money used effectively, and they want their children to be in a position where they can take advantage of it. And sometimes we're in a situation, some families are so successful that their children might not be more successful than their parents, just because of the occupations they take on. And so now the parents are in a situation where they're going to provide help for them on an ongoing basis. So how do you plan to minimize, for example, taxes over 2 generations versus 1? Because some of the decisions you make, if it was just 1 generation, are different than if you have to plan over 2. So having us involved as much as we can with the next generation is actually helpful. One of the words I would take that you used earlier is continuity. We have continuity with the parents, and we understand how that flows. And if the children are willing to work with us, and not all children will because they have their peer group and their friends, but we have younger advisors on our team that could probably connect. They probably might look at me as being too old. But we create continuity and communication because we're all the same firm working together. And so I think it's helpful in that case. And that's what I call the more ideal situation. And if it's not, and we have to work with other advisors or CPAs, if we are the kind of like the family office for the family, then that's part of our responsibility, is also to be able to work with other people that the children might bring into the fold.
Another interesting point to what you're describing is also, what's the source of wealth? Because if the family's source of wealth is a closely held business, and maybe you've put the business into trust, and
that's interesting.
Some of the next generation wants to be a part of the family business and others don't. It really helps to have a trust to sort some of those issues out, and to have these family meetings where you're able to help facilitate the decisions that are maybe challenging for the next generation. I don't want to disappoint mom and dad, but I really don't want to be a part of the family business. I'm an artist and I want to go do something else. I think source of wealth is a big consideration, and real estate's another one. If you're a real estate family and you own a lot of residential or commercial real estate, how is that going to impact the next generation? You don't necessarily want to have to say you get this building and you get that house,
right.
but you put it all into trust and everyone can benefit from the income that's generated. Maybe you don't have to sell the family house.
Right.
So there's, all these things. I think it's where family dynamics and the use of trust really come together.
Correct. And I agree with you. The more complex the asset is, and complexity, it gets increased when the asset, like you said, is a business or real estate. Those become less and less liquid. Mm-hmm. And in a family business, for example, you could be an owner and not work in the business. Mm-hmm. That might be a good thing or a bad thing, but not everyone that's a family member should be an owner. Not everyone who's a family member should even work in the business. Mm-hmm. But if a family, if the matriarch and patriarch feel like, hey, I want to treat my children equally, mm-hmm. then we have to find a common ground when you have a complex asset that in the parents' eyes treats everyone, what I call equally, is different than fairly. Mm-hmm. So there's fair and equal. So mm-hmm. Again, this is always driven by the parents, and trying to find out what their intent is most important. But once you understand the intent, using these trusts to kind of manage things, these complex assets, helps take things down to a level where things can be more efficient.
That's right. Absolutely.
So
yeah.
Well, thanks, Kate. I know we probably run over time here, but I appreciate making sure you came in and were able to share your deep knowledge on trusts, corporate trustees, their responsibilities, the things that they have to be involved in, the differences, comparing that to an individual trustee. So I want to thank you for your time and dedication to us and coming in. We'd love to hear any feedback from everyone. So if you want to provide us any feedback, please visit us at returnonlifewealth.com. If you have any questions or would like a copy of questions to ask about a corporate trustee, you can call us at 877-514-9991. And we want to thank all our listeners for staying tuned in. And thank you.
This has been Frank Wealth Insights, the financial and investment podcast from Return on Life Wealth Partners. Your life, your money, your way. Experience financial planning the way it should be, not the way they want it. See how at returnonlifewealth.com. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. This communication expresses the views and opinions of the participants as of the date it was recorded or indicated, and such views are subject to change without notice. This podcast is being made available for educational purposes only and should not be confused for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. This podcast may discuss forward-looking statements that are based on then-current beliefs of the participants. Investment advice offered through Planned Financial Services, a registered investment advisor.